Welcome to Crash Concepts, where the economy, energy, and the environment are explored. Up next, fresh ideas and insights into the factors that are driving the world and shaping your future. Presenting information you can't afford to live without, here's Chris Martenson.
Welcome, everyone, to this Featured Voices podcast brought to you by Peak Prosperity. I'm your host, Chris Martenson, and it is February 25th, 2020. Yesterday, stock markets around the world finally caught up to the risks and realities that the coronavirus pandemic presents to corporations, the global economy, earnings, and all the rest. And the Dow fell more than 1,000 points. It was a really rough day for equity markets everywhere. Look, we don't have a lot of time to squeeze in today's podcast, so we're going to just jump right in. We've got Sven Henrick back on. Sven's insights can be found at northmantrader.com, also on Twitter using the handle at Northman Trader, all one word, Northman Trader. Sven is founder and lead market strategist for Northman Trader. He's been a frequent contributor to CNBC, Wall Street Journal's Market Watch, and is well known for his diligent technical, directional, and macro analysis of global equity markets. Can't think of a better person to have on this morning. Sven, welcome back.
Hey, Chris, how are you?
Good. As I told you before we started recording, I'm alert and watching things like a hawk. Sven, the markets tanked yesterday. Why?
Well, first of all, let me just say that the market has been on an incredible run since the Fed just went absolutely hog wild on liquidity injections when they started responding to the repo overnight funding crisis. And as a result, we've had what might be described as a global blow-off top, if you will. I mean, equity prices exceeded far above any fundamental basis of the economy. In fact, if you look at some of the larger GDP indicators, last week, actually, as the NDX, tech, and the S&P made new all-time highs, the market ended up at a valuation of 158.9% above GDP. That's higher than it was during the tech bubble in 2000. And there's a number of other indicators you can look at, price to sales, EBITDA, all those type of things that point out to an extremely highly valued market that comes at a time when obviously earnings have been slowing down dramatically in 2019. And this whole notion was that we're going to have this big reflation trade into 2020, right? Because central banks are intervening left and right and center, and all this liquidity is going to get the economy going. What happened, what was really interesting in the tail end of 2019, while markets kept rallying, the bond market did not confirm the rally at all. We had weakening in the yields all along. And that happened before this whole coronavirus situation occurred. And so in response, markets just kept going on this massive liquidity run, ignoring everything, ignoring the bond market previously, ignoring the coronavirus previously. And so we got to extreme high technical extensions, and those were ready to crack. I've been writing about this last few weeks, how the rally was continuing to narrow, ever smaller participation. It was basically held up by five stocks, right? The big five tech stocks. And then finally it cracked, and it finally got a trigger. And so we had a massive reversion yesterday. For example, the Dow, even the S&P basically gave up all its gains in 2020. And so this is what happens, right? You get far extended, a trigger happens. The technicals are building in the run-up to this, right? You got all these divergences that don't seem to matter until they do, and they finally mattered yesterday. And so we had this big crack and kind of a flush out, an initial flush out, I would call it, of the excess that has been building.
I want to talk about that initial flush out, but to back up a bit, you talked about this great reflation that had happened, and it started with the Fed intervening in the repo markets. That was back in August and September of 2019. That really jammed things for a bit, but, things started to weaken a little, and coming into January, it was kind of topping, it looked like to me. I'd love to get your impression of that. But what amazed me was around January 31st, this is when the coronavirus news is really hitting. And from there, the S&P climbed over 200 additional points to hit those all-time new highs you just talked about. In the face of obvious and increasing coronavirus issues, was the market just completely ignoring the coronavirus issues and feasting off of Fed liquidity, or did something else happen there? How do we explain that?
To me, it means to really keep it simple, stupid, as one would say. Just look at the Fed's Treasury holdings and their repo activity. The push back into Treasury bills buying was so aggressive, it was more aggressive than we saw in 2009. And in fact, as of last week, the Fed's asset holdings and Treasury bills buying was just $14 billion shy of the all-time highs. So remember, in 2018, and to me, this is kind of the big macro story altogether, right? We had, 10 years of intervention, and the Fed tried to basically taper a little bit to try to normalize, right? They started to reduce their balance sheet, and they were able to do that when the U.S. tax cuts came in and provided all this additional liquidity with buybacks, right? Companies saved a lot of money on taxes, and they pushed a lot of these savings into corporate buybacks. So they were able to do this for a little while, but then it blew up in their face. In Q4 of 2018, we had this big 20% correction, and then obviously, they were forced to go right back into it, right? It started with the job owning in the early part of 2019. Then we had 3 rate cuts, all of which were sold initially, by the way. The markets did not really take off until the Fed announced it's what they claimed to be not to be QE, but it was really very aggressive buying of Treasury bills. And then on top of that, that repo program that kept being accelerated. And guess when the first week was when they started tapering that repo program? It was this week.
This week?
Into last week's. So basically, we still had last week when an S&P and NDX made new all-time highs still on this very narrowing path. We still had big repo operations. And I've been Twitter fighting with one of the Fed governors on Twitter. There's so much denial going on in terms of what is. Do these liquidity operations have any impact on equity prices? And I'm fascinated because for weeks and weeks and weeks, what we've seen is no matter where the market opens up, either down or up, in most cases up because we've been running on overnight up gaps. Before the market opened, the Fed conducts its repo operations. And even last week, we still had some big meaty repo operations, 60, 70, 80 billion dollars, right? These are short-term liquidity, but the liquidity provides, at very least, it provides a psychological boost to traders to say the Fed's in, and so we can buy anything we want. And so you see every morning this massive ramp up in stocks. Guess what happened on Friday? On Friday, they had the smallest repo operation in all of 2020. It was only $26 billion. And markets tanked. The support just simply wasn't there. So if you look at the market in context of ignoring the news from, for example, from the coronavirus, as it did in January, we had that little dip, but we still had these massive liquidity operations, right? And then all of a sudden things started to slow. They started to kind of fall to the wayside with the larger market not participating. And then all of a sudden you have a reduction in liquidity, and then you get the news of this virus spreading globally, boom. And you had the trigger and the lack of support that was built in this market with all these overnight gaps had that effect that we saw yesterday. It was a complete flush out.
That's fascinating. So what I'm wondering, though, is who's doing all this buying? So I read some news last week that in the face of all this liquidity, of course, stocks are going up. You mentioned the big 5. So Amazon, part of that. Amazon's just climbing and climbing and climbing, and we find out that Jeff Bezos harvested $4.1 billion, sold $4.1 billion of stock into that. Well, somebody paid $4.1 billion. Who is that, Sven? Who's doing all the buying here?
Well, I mean, look, you have on the one hand, you have asset managers that need to catch up. You have the FOMO effect, basically. I mean, look, the reality is because the market is so skewed in favor of just a few stocks, all these hedge funds are underperforming, right? If you don't, this has been kind of this absurd message that the Fed inadvertently sent to the market, right? If you're hedged, you're underperforming. If you protect yourself, you're underperforming. If you're not in a few key stocks that are outperforming and you're diversified across the universe, you're underperforming. So you're always kind of trailing the index. Like even Warren Buffett is trailing the index, right? It's a really challenging environment. The second part is last year, and you may have noticed there's a lot of the retail trading companies have gone away with commissions. There's been quite a few anecdotal information as of late that retail has really been jumping on the wagon here, especially when you look at call option volumes and so forth. So there's a lot of retail that has participated in this and has been chasing some of these stocks. And you see this really unhealthy behavior where they chase Tesla to the moon or space or what have you. I mean, absolutely vertical charts, but also Apple. Apple has, basically doubled from the lows in 2019. Remember, in January 2019, they had a big revenue warning. And the stock has experienced the largest market cap expansion of any stock in history ever. I mean, it was absolutely fascinating. And they just chased these stocks up into ungodly valuations and overbought readings. So no surprise that we're finally seeing a reaction. Whether that's the final reaction, we'll see.
I don't know about the final reactions. I think Apple lost 3 or 4% yesterday off of those massive all-time, sort of highs you've talked about. But Apple has been warning, and I want to get into the supply chain issues here very quickly. They've got a lot of exposure to China. They've got their Foxconn plants over there. We have all these stories which are so massive they're hard to get our arms around. 30% of Chinese people are back at work, leaving 70% who aren't. But that's just the first order effect. The second derivative, we don't know how many factories have to supply the factories to supply the components to Foxconn. Like, that's just too complicated to really unravel right now. But we do know that Apple's very, very highly exposed to that. Do you think that 3 or 4% off of their stock price yesterday, that represents a fair risk adjustment given what I just talked about?
Well, we've all been trained by central banks, basically, and it's been successful up to this point to ignore all bad news because nothing ever matters. Mm-hmm. That's dips don't last, right? I mean, this has been kind of this risk perception has been altered for that reason, and so there's an ingrained Pavlovian reflex to say, virus, whatever, who cares, right? Ebola, who cares? It just doesn't matter. It goes away. And so far that's been correct, and the world has been really lucky. If you talk about viruses, for example, right? I mean, we've been in this world where we've had incredible medical advances, and viruses can be contained like SARS, or Ebola is obviously not transmitted by air or what have you. But the underlying threat has always been, what if we have this most overpopulated world ever? If you get a virus that actually is much more difficult to contain, what is the impact? And I don't think anyone's really thought that through in any shape or form. And to the extent that what was promised to be a short-term virus that is contained is actually not such, as we are now seeing as it's spreading into Italy, Iran, and South Korea, we really don't know. And if you listen closely to the World Health Organization, the WHO, they came out yesterday and said, we really don't know how it is transmitted, and we don't know how to combat it yet. I mean, you hear, obviously, some pharmaceutical companies are trying to come up with a vaccine, and I hope they do, because I don't think any one of us wants a pandemic. But the fact is, we don't have any clarity at this point how long this is going to take. And we're seeing multiple economies, big economies on the globe, already on the verge of recession. Germany had 0% GDP growth in Q4. That was before any coronavirus even hit, right? So Germany is in trouble. UK is in trouble. France is in trouble. Italy is in trouble. South Korea is now in trouble. And of course, China is in trouble. So to the extent that you can think that a company like Apple, which is massively internationally exposed, can have little impact from that, I think that's a fantasy.
Yeah, I would agree. And I'm getting, in my position here, I get a lot of emails from people explaining what the supply chain issues are for them. And here's one thing that sort of emerged. Almost all of them, some people have just gotten their money straight back from orders they've placed in China. They're just like, hey, we're not even going to tell you when we can fill your order. Here's your money back, which is very unusual. And if people are getting any sort of a promise that, hey, we think we can get to your purchase order by X, June, everybody's being told June. And of course, so many people have gotten the June response that it feels a little bit like a CCP message to me. It's like it's across fabrics, electronics, chemicals. It's kind of June. So to me, if you get out into June, we already had that big Bloomberg article yesterday talking about how there are 5 million Chinese firms that have only 30 days cash on hand. And after 30 days, it gets to be real trouble. Last I checked, we're in February, so March, April, May, June. That's 4 months away before potentially the cash could start flowing. This feels to me like something that printing and shoving money into the markets just can't overcome, but the Fed's going to try, right?
They're all going to try, and we see that already. The market started, and this was hilarious yesterday. Actually, last week on Twitter, I asked, how much market pain they're basically willing to endure before they're starting to cut rates again. And already yesterday, the market started pricing 2 more rate cuts in 2020. There was even calls for rate cuts now before the March meeting. I mean, this market continues to be so dependent on central bank intervention. It's almost pathetic. Well, it is pathetic at this point. I have to really say, the notion of free market price discovery or normalization of rates and balance sheets. I think that ship has long sailed now, and you see markets reacting to the jawboning. In fact, last night we got the political jawboning, right, from Larry Kudlow and then President Trump, right? And they are worried about a dropping market because, I keep saying, that the economy is not the stock market, but the stock market is the economy. The worst thing that can happen now in an aging business cycle where growth is already structurally slowing and has been slowing for quite some time. And obviously they keep trying to prevent a recession by filtering ever more liquidity. But the worst thing that can happen now that they've created these massive extensions in markets above the underlying economy, that a larger sell-off would actually be the trigger that would bring about a global recession, right? Because so much of the asset financial values and confidence is tied up with stock markets. So you lose the stock market, you lose the confidence, and with the confidence you lose the spending, and you get the recession. And take Germany as an example. Made all-time highs here just recently, last week, and the economy is growing at 0%. Or perhaps less this year. I mean, there's just no rhyme or reason, or it's basically all distorted at the end of the day. The TINA effect from lower yields, and I think the big question is, what signal is the bond market? Has the bond market been sending for the last several months? And at some point, either the bond market or the stock market is going to be right, and there's a big disconnect going on right now.
So I'm wondering, from a technical standpoint, what technical levels are you watching? Did any technical damage get done yesterday that you would see some attempts to try and repair today? So pick an index. Where do you start? What are you looking at that seems important right now?
Well, let's basically focus on the S&P, the big animal, if you will. There was some damage done, but basically we just hit the January low, so we had support there for now. We got short-term very much oversold because this was a big flush yesterday. So a bounce here makes perfect sense. The question is what happens after this bounce. Remember, we had a bunch of up gaps on the way up. Several of them got filled yesterday. Now we're having gaps on the other side. Important to mention here is the VIX. It had a major breakout. Been talking about this since January that there was a breakout coming. We had that breakout yesterday, and of course there will be attempts to put that animal back in the box, if you will, right, to crush the VIX. However, if that next bounce fails to make new highs, we're looking at a more sizable retracement, possibly into the 3,000 zone, maybe even a little bit below. Depends on how this plays out. Keep in mind, this whole run-up here actually was very similar to January of 2018, right? Following the tax cuts, we had this massive jam up, very tight patterns, very little price discovery, and then suddenly something broke. So I think that, to me, the year basically now is binary, and it's all about control. And the virus will have a large say in this as well, right? The central banks will keep intervening, they will keep cutting, and they will keep printing. There's no question about that. The question to me is efficacy, and the virus in context of the larger slowing economy will have a big impact. If the virus can get contained in, let's say, in the next 3-4 weeks, and we see a market decrease in infections and maybe even they get a vaccine, although I don't know if they can or not. then you can make the case, okay, we're going to have a nice retracement, gets us into, let's say, 3,000 zone, roughly 3,030, 29.75, something like that. You could have then a bottom for the year, and all this liquidity will flush into the U.S. election, and we can get another run to new highs. But frankly, if they fail to contain this thing and this supply chain, to your point, gets extended, I think we're looking at a global recession. I think then all bets off. And so if you see a sustained move below 3,000 on the S&P this year, then I think things could get rather hairy, and we can go back to some of the levels that we saw in 2019 or below.
Yeah, and this is, Sven, why I'm tracking the coronavirus so carefully. This is what I'm doing on a daily basis, simply because I don't think it's uncontainable at this point. It's slipped all containment. So now it's a management issue, and there's a three-body problem that the authorities have to solve. One, the only way to actually contain it is to do what they've done in China, which is to basically lock people in their houses. Either you do that willingly or unwillingly, but that's what you do. And that, for sure, will help to slow the spread of the disease. But guess what? Then people aren't working. That's your second body problem. Hey, you still need to produce food. You still need to keep your economy going, because that could be worse. If the economy really collapses, it could be worse than actually whatever results from the virus. You got to balance those two things against each other. But the more you put people back to work, the more you risk the third body problem, which is that if it gets too out of control in an area, it swamps the hospital system, and then you have much, much worse outcomes, much higher case fatality rate. So we have to balance keeping people locked away, letting them back to work, but not letting this thing get out of control too much so that it swamps the hospital system. It's a very tricky thing, and I don't think anybody alive has had to balance those before. So that's, to me, that's enough uncertainty that I would think that reasonable traders and investors would say that's risk. I would like to not expose myself completely to that risk and be all in. So I think it's going to take time for the markets to actually digest that message because it's new, it's subtle.
Yeah, I mean, I think we're dealing with two narratives here right now. I mean, there's the one school of thought that says, okay, well, all right, we recognized all of 2019 earnings were flat and not great, so we ignored all that because the Fed was printing. And okay, so now we expected the big Q1 bounce. Well, that's not happening either. So let's just ignore that for now too. That's 5 quarters in a row, and we're hoping, okay, this virus will solve itself, and then we're going to have this big rebound in the second half. So I think that's kind of the school of thought that tells some people to stay in stocks and just ignore everything again. The issue is if this does not get contained, and all of a sudden and this is why I think listening to companies' warnings now is incredibly important, and companies are warning, right? Apple was one of them, and they ignored that too, right? Remember, Apple dropped, it went right back up. Well, that was a mistake. You're starting to see dip buyers getting punished, right? For weeks and weeks, you could buy anything and it just went up and it didn't matter. But last week, they ignored the Apple warning, Apple bounced, and then it got hit hard yesterday again and actually broke trend. So to me, a market that is as highly valued as it is now, with such high forward multiples that has been priced to perfection, it can ill afford that anything beyond Q2 or beyond Q1, Q2 is going to be impacted. And I think so far everybody's ignored the reality of what this virus actually implies. It was just not discounted. And I think the Italy news this week and the South Korea news, I think, shook things up dramatically, and then we'll have to see how this evolves in the next few weeks. I think it's key. You see President Trump, he said, it's going to be all solved by April.
Yeah.
Well, okay, that's the expectation that's now set. And what if it's not?
Mm-hmm. Yeah, and there's another subtle narrative in here that was important, which for a while it looked like, for whatever reason, this virus might have been contained to Asian ethnicities, but the outbreaks in Iran and Italy just shattered that. So there's now an idea that, this actually is a worldwide thing, could go anywhere. Now it's down to the containment. you got the president being hopeful about it, but we're going to have to watch and see. So you just mentioned something really important about the corporations. Follow them, follow what their warnings are. We're seeing lots of them. I can barely keep up with the corporate warnings. You mentioned retail buyers, Sven, as being kind of getting back in the pool and swimming around. But as we all know, corporate buybacks were a hugely important part of this overall dynamic of hugely important. You need buyers in order to make stock prices go up. I'm wondering what you think about. Here's what I don't like about credit bubbles. It's so easy on the way up, but as you mentioned, if the stock market goes down, that could feed right into the actual economy in a synergistic sort of, these things play off each other. Corporations were doing a huge amount of the buying. And all of a sudden, if they're looking at a supply shock sort of a warning, they're going to, I believe, get conservative with their buybacks. And that would remove one of the largest, if not the largest, sources of buying. Do you agree with that? And if the corporations back off, who replaces them?
Well, I mean, this is the thing, right? You have everybody long exposed. I don't know if you saw this, but last week or the week before, the actual short interest in SPY, the ETF that tracks the S&P, was one of its lowest levels ever. So, be clear, this drop that just happened, I don't think the market was positioned for it at all. And to your point about liquidity from buybacks, companies ultimately are rational entities, right? And they do buybacks because it benefits them, and if they have access to cheap debts, they can certainly finance that. If they get a big tax cut, they can finance that. But once you start talking about impact on profit margins in a big way, we saw this in 2007. Buybacks stopped on a dime, right? They had been increasing buybacks all the way into 2007, and obviously that kept supporting stock markets as well. And then they stopped immediately, and obviously we saw what happened then. At the end of the bull market, it always looks the rosiest, and everything looks, the most invincible, if you will, right? And things get ignored, like the building housing crisis was ignored back then too. It's always the unforeseen trigger that you don't see, and then behavior changes quickly. We haven't seen that behavior change yet. Certainly not at 4 or 5% down, but we saw some of that last week. It's subtle at this point, but I think it's notable. All of a sudden we saw some bearish patterns in the short-term charts, and all of a sudden they worked. On last Thursday, I'll just point this out because I highlighted this on Twitter because I thought it was really interesting. On Thursday, there was a little down, and then the NASDAQ rallied, and it built a tiny bear flag. Not a big deal, you would think, right? And all of a sudden, out of the blue came a sell program. And everybody was like, where did that come from? What news triggered this? And they were desperately trying to figure out if there was a news item that triggered it, and some attributed to some sort of coronavirus news report. But it really wasn't that. There was a technical pattern that was already bearish, and it flushed. And then it built another, that rally that followed the initial drop on Thursday, built another bearish wedge. This was when everybody declared, they're buying the dip again and everything is in the clear. Now, it flushed again on Friday on that. And then, of course, on Monday, we got the flush. So all of a sudden, I see a shift in behavior in the market. And we'll need to see if that follows through, or if this is just another one-dip wonder, and they're trying to rally this back to new highs. I'm somewhat doubtful that unless they get the all clear on the virus, I'm very doubtful that we are going to get new highs from here anytime soon. I think we're going to have to flush through all this. And let me just maybe add this final point. To see all-time highs happening in the February-March timeframe is not unprecedented, right? There's actually two specific examples for that. One was 1937, if we want to go back that way. We also had a massive rally from 1936 into 1937, and it ended in March. And then, of course, we have the infamous 2000 example. And what's really interesting about 2000, and I think everybody should be aware of that, we obviously had the tech bubble. What precipitated, or what really gave the tech bubble its final blow to the upside? It was the Fed. It was Alan Greenspan. Back then, it was not repo, but it was concern about what might happen with Y2K. You're old enough to remember this, Chris, right?
Yes, I am.
A bunch of concerns. Every computer is going to blow up and power stations are going to go up. Nobody knows what's going to happen. So the Fed, in anticipation of Y2K in late 1999, added a whole bunch of liquidity. And that liquidity magically made its way into the stock market. Retail got on board. Everybody chased every vertical stock on the planet. And then, boom, it was over in March, right?
Yep.
And the Fed ended up reducing liquidity because it pulled it back because obviously Y2K didn't cause any damage, and so everything was fine. They pulled back the liquidity, and all the excess became unwound. And this is kind of ironically, historically, what we're seeing now, right? The Fed in September started adding a bunch of liquidity with treasury bills buying and repo, and they caused a massive asset bubble, as far as I'm concerned, as a result of that. And now they're trying to carefully extract themselves by trying to taper the repo and want to end the treasury bills buying around April, they say. I don't quite trust them on that because, again, as soon as markets drop, they want to do whatever they need to do to save it.
Yeah, and I understand that. Yeah, I get that. And at the same time, so the bull case, I get it. The Fed's throwing money into the markets, and that's always been correlated very highly, despite what your Fed Governor Spat is going there on Twitter. Despite what they say, market traders all know this, that one of the best correlation series out there is looking at central bank balance sheets and then global financial asset prices. So I get that, right? But on the other side, on the bear side, you might say, well, wait a minute. We're watching the Fed have to pour more and more and more money in on an overnight basis to get less and less and less of a return. I think we've got a tire with a leak in it. And at some point you have to wonder if you're not going to get a completely flat tire out of that. And that's just the nature of things. I think the Fed goofed. I think they should have had emergency measures from October 2008 into maybe spring 2009 and dialed it back and let things get on their way. And if certain things like Citi had to go belly up as a consequence, so be it. We'll survive that. But now they've given us, instead of, Sven, my model is instead of falling off of a 5-foot high step ladder, we're now 30 feet up an extension ladder. And I just see massive air pockets under here if this thing gets rolling. Would you agree we're a little maybe overextended from valuation, debt, all sorts of measures? Feels just really extended to me.
No, it's a process of diminishing returns, and I've questioned the whole issue of efficacy last year. Personally, I have to say I was amazed to see this liquidity run here in Q4 into the beginning of this year. And you have to wonder at the end of the day how much of this was intentional and how much of this was forced on the Fed. So they didn't choose repo. They didn't choose the repo crisis. For your listeners, in September, there was one night, all of a sudden, overnight rates spiked massively 5%, and they had to emergency intervene because there were liquidity issues with some of the overnight funding. And they've been running this program ever since. And to this day, even today, it's oversubscribed. So there's a lot of demand. And if you will, the jump in equities has been kind of the unintended consequence, the side effect. So to the extent that this was forced upon them, they've now produced a bubble, and they don't know how to extract themselves from it. And at the same time, we look at the actual economy, and we don't see the effect. The effect hasn't been there for a long time. Europe is still on negative rates, and Germany is at 0% GDP growth. The structural issue has never, the structural picture has never changed. We are in a slowing business cycle. It's the slowest recovery we've ever had, but we have to spend more and more and more debt just to kind of mask the underlying issues. I mean, we're $1 trillion deficits, right? And we can even get 2% GDP growth here, barely. Yeah. I mean, all this is paid for, and to your point, they should have stopped a long time ago. But every single time there were troubles in markets, central banks have stepped up. They're not willing to take the pain because they're afraid of the beast that they themselves have created. So that's why we had QE2 and QE3, and then in 2016. We had global central bankers jump in with $5.5 trillion of intervention between 2016 and 2018. So they keep just exacerbating the disconnect between asset prices and the size of the economy. At the same time, what all this is producing is ever wider wealth inequality, as 10% of people own 90% of the stock market, right? And so, yeah, you have the Jeff Bezos and the Mark Zuckerbergs, and then others that are just reaping and massive benefits from. I mean, my classic example is Bill Gates. Even he's whining about it, saying, "I shouldn't be able to make this much money." He's one of the richest guys on the planet, and he's actually retired, right? But he can't help, and he's giving more money away than anyone we know on the planet, right? He's doing a lot of philanthropy, but he can't help getting richer because he still owns Microsoft stock and other shares, of course, as well. And these asset prices just keep going wild to his and other people's benefits. And then you look at the global political picture, and you see ever more discontentment and politicization and fragmentation of societies, to the point where no democracy can actually get anything done on a structural basis. So it's very concerning. We're kind of on this train that keeps running, but it's getting heavier as we keep going uphill.
Yeah, I totally agree, and a whole separate conversation, but the social impact of what the central banks have done with the Federal Reserve at the head have been deplorable in my mind, because they've been engineering a very, very unfair, unjust wealth gap in pursuit of something which they can't actually articulate. It's like, we're going to keep printing and making stocks go higher until what? I don't know what the what is in this story. So, Sven, I know your time is short here today. Last question, if you have the time. A lot of people listening to this may still have money in the markets, and I'm just wondering, given where you see things upside versus downside, should people who are fully invested or more invested than they're comfortable be taking money off the table here, maybe protecting gains, stepping aside and watching for a while? How would somebody play this?
Well, I'm not someone that gives financial advice. Let me be clear. I mean, we just look at this through a technical lens.
All right.
But I will say this from a macro perspective. I think from my perspective here in 2020, there is a chance they can still kick the can one more time, if you will, maybe into 2021. I think a lot has to do with how this virus plays out. But we are at historically stretched valuations. We're in an environment where 5, 6, 7, 8, 9 stocks control very large portions of the indices. We have a bond market that's not confirming a reflation trade to growth. And we have trapped central bankers who are now, and this is, I think, the biggest part of what I call the recklessness of it all. Right? Central banks originally were supposed to be lenders of last resort. They were supposed to be there when things really go bad. And now they've morphed into a self-anointed, classification of, we're going to always intervene at any sign of trouble, and we're never going to let the system cleanse itself. From my perspective, we're in a massive asset bubble. I'm not one to tell you that we topped last week or we're going to top a few months from now. I'm just saying, from a risk-reward perspective, if they ever lose control of this construct that they have created, we have massive downside risk in equities. And just go back to something I mentioned at the very beginning, 158, 159% market cap to GDP. Put this in historic perspective. In the 80s and 90s, this was around 60 to 80%. We had the tech bubble that peaked around 145%. We had 2007 bubble that peaked around 137%. So we are massively extended beyond any history where we've ever been, especially in a slow growth environment. So you got two things to consider here. Either this continues in something that has never happened before, will continue indefinitely, or there's going to be some sort of reversion right sizing of this. And even if you go down to, which is also a historical high, let's say 120% of GDP, market cap to GDP, you're still looking at a massive downside risk in markets. And keep in mind, in 2009, we went down to about 60%. So, I mean, these things can change quite dramatically. To the extent that the top 5 stocks, tech stocks, remain overowned and continue to be bought, I think you can keep these valuations up. But anything breaks on these, there's a lot of people that all own the same stocks, and they may find the exit door rather thin.
I agree. And the idea that the central banks and the Fed in particular have painted themselves into this corner where they have a narrative that has to be maintained, which is that they are going to intervene, which is they've got it, the put exists, that they can print, that they can make everything better. But we're putting that, so I think, to paraphrase what you said, all of stocks have been priced for perfection, and it's not a perfect world. We had this thing called the coronavirus, which is my definition of almost a perfect black swan. Totally unexpected. Nobody's faced it before. Who's alive. We don't know how this is going to ripple through. Can't compare it to the 1918 Spanish flu because at that time, most people lived on farms still. This is a completely different world, and we don't have any models for it. And that is something you just can't print your way around very easily. So if the perception that the Fed is now out of its element and is facing something that it can't control, I think that busts the whole narrative, and people are going to have to spend some time getting used to a lot of volatility until we figure out what the correct narrative actually is. But I think the old one is really in danger of being just shredded by one of those machines that takes the cars apart. That's what it feels like to me.
Let me just add this point here. I mean, to my point about this being reckless, when the Fed was supposed to be the lender of last resort, they have now very little ammunition left on the rate cutting front. They only have 6 rate cuts left before they're back to zero. In 2000 and 2007, it took over 500 basis points in cuts to stop the bleeding. And to the extent that they went back full in 2019 because of the slowdown to try to kick the can, they again reacted to the market's insatiable appetite for easy money. And they're just not willing to take the pain ever. They're so afraid of the beast that they've created that they are beholden to markets. And so now, if the coronavirus, for example, is actually turning to be out that emergency, that trigger that actually requires you to have an army with ammunition, while the Fed has left itself with precious little ammunition. And that's the irresponsibility of it all. Look at the ECB, negative rates, and they cut again. And they've restarted QE. Well, what new stimulus can they bring? Well, the answers, and I think they know that, is very little, and that hence why you see central bankers across the globe basically begging governments for fiscal stimulus, which is code for add more debt. Well, great. So now we are in the most indebted economy, global economy ever. We're at the lowest rates with the least amount of ammunition, and you hope that something like a coronavirus is just a temporary thing. Well, the concern is that something like that is not a temporary thing, or we have a real crisis, and we're completely left unprotected in that sense. Yeah, they will try to keep kicking the can, but every time they do, every time the Fed cuts rates, for example, they will have even less ammunition to deal with this aging business cycle. So the future, unfortunately, as it looks right now, is permanently ever more debt. We have trillion-dollar deficits for the next decade, at least. That's prior to any recession, because none of these models assume a recession ever. And so I think the world is mightily exposed. At the same time, as long as stock markets are high, you can maintain that confidence. That's why I say everything is about the stock market, and everybody is trying to protect it with any shape or form possible.
That was so perfectly well said, and we're going to end it right there, Sven. That was amazing, and I just love talking to you, and I love following you on Twitter, and you're just very generous with your insights and with all of your analyses and things like that. So thank you so much for your time today. I know you've got to get to the markets because they're about to open here. I really appreciate it. I'm sure everybody listening has really appreciated this as well. So again, tell people how they can follow you, please.
Oh, yeah, you can catch me on at Northman Trader on Twitter, and of course the website northmantrader.com. And Chris, thanks very much. I very much enjoyed speaking with you.
Thanks again, Sven. Good luck with all your trading and with life going forward.
You got it. You too. Take care.
Worried about what the financial markets will do from here? Hi, folks. This is Adam Taggart. Chris and I are the co-founders of peakprosperity.com. Given the macro and technical risks that Chris and Sven addressed in this podcast, we think it's extremely important not to have your investment portfolio on autopilot these days. We've long recommended that you work with a professional financial advisor who understands the nature of the risks involved with today's markets, and to position your wealth accordingly for safety. If you're having trouble finding a good advisor on your own, consider talking with a financial advisor that Peak Prosperity endorses. For over a decade, they've worked with people just like you, who are concerned about preserving capital during a time of dangerously overvalued markets. You can talk with them for free, no strings attached, and no commitments required. To schedule a free consultation, just go to www.greylockpeak.com. We think you'll find this a useful resource. Thanks for listening to this podcast.